Welcome to the Wealth Standing Podcast. This is episode 508. Today is January 16th, 2026. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. I've got a lot of questions about the banking sector. A lot of people are concerned about the proposed cap of 10% interest on credit cards. They're wondering if I'm worried about that, if I'm selling. No, I'm not selling. I'm holding my positions in the ETFs that I bought a few months back. We'll talk about all that today. Before we get to all that, though, we're in a new year, and I always get questions about, am I going to do a live Q&A session? I know you guys love listener question episodes. I don't encourage people sending in questions because I just don't know when I'm going to have time to answer them, and I don't want to, build false expectations that if you take the time to submit a question, it may never get answered. But I know there is a lot of interest, and increasingly as other podcasters and things have done like live Q&A sessions, some of you have asked me about that. The problem with that, it's twofold. Some of it's a technical issue. But I guess more than anything, the only avenue I would approach that through would be live broadcasting it on YouTube. And I know there's a lot of other options, but, I'm not a content creator. I'm a money manager. That's my main business. I do this podcast as an adjunct to that business, and more than anything, it's a labor of love. But because it isn't a business and because I'm not a content creator, I have very limited access to where I, put the podcast out. I'm not interested in a lot of those areas that other people go to. I mean, even just the normal stuff. I don't do a Reddit Substack. I'm not even on LinkedIn anymore. TikTok, X, none of that stuff. I just don't do it. So if I were to do a live Q&A, it would be on YouTube. The problem with that is that my listenership over on YouTube or followers over there is minimal. So I really don't know that it's even worth the effort to do it over there if no one's going to watch it. And I guess my question is, if I were to do it and say we had regular scheduled things, once a month or something, what would be the best time frame? Again, I know a lot of other podcasters or YouTubers do them during the day, and I've always had a sense that my audience is, not kicked back watching YouTubes during the day. They're probably out there working for their hard-earned money so that they can earn, save, invest. So I guess two questions. One, is anybody interested in live Q&A sessions to watch on YouTube? And if you are, what's the best kind of day of the week or time of the day that would work for you? Okay, back to the main topic. I'm not concerned about bank stocks in general. Specifically, I'm very much in favor of owning regional banks. If you go back to my blog post on investablewealth.com, dated November 12th, on that day I mentioned a transition into financial sector in general. Of those four trades, the only one that's really not doing well is Visa. I'm not even going to talk about that today, but I am definitely not worried about Visa for the long run. And especially with, I guess I would say this, I'm not going to ever encourage you guys to go out and buy something, but look at Visa right now. A lot of the fear is about this cap on credit cards. Visa owns the plumbing of the credit card lending business, but they don't have any actual loans that they issue, right? Other banks make the loans. They just use the Visa network to access the clients. And while there could be an argument that people will get cut off from lending and therefore Visa would be able to issue less credit cards, again, I don't know. I think Visa is just one of the best run companies in America. This could be a buying opportunity. Take a look at it. But what I really want to focus on today is the regional banks. And if you'll notice on that blog post, I mentioned that I bought an ETF, KRE. That's the Regional Bank ETF. Now, generally, over the last, many, many years, ever since discount brokers got away from charging transaction fees on owning individual stocks, I've been a huge proponent of just buying individual stocks. Why buy an ETF if you can cherry pick and create your own ETF? And generally, that's my philosophy. Sometimes, though, I do buy ETFs. KRE is one of those ETFs that I like. I like it because it does what a good ETF is supposed to do. It allows me to focus specifically on regional banks, right? The targeted fund that I want to be invested in. But more importantly, it gives me broad diversification within that small niche. So if you look at the top 10 holdings of many ETFs, they'll have 50, 60, or in some cases a lot more of their whole market capitalization in just 10 stocks. Well, take a look at KRE. Its top 10 holdings represent probably less than 20% of the value of the fund. So you're really not getting any more than like 2% exposure in any one bank. And then within those broader holdings, there's close to like 150 regional banks that you have ownership in. So you are getting sector-specific concentration, but you're also getting broad diversification within the sector. I think that's very important with regional banks because there isn't a whole lot of transparency. You really don't know what good or bad loans are on their books. And so I don't want to put all my eggs in one basket betting on 2 or 3 regional banks. I just rather would own KRE. And I do have an overweighted position in that ETF. Roughly, I have about 5% of my overall portfolio just in that one ETF. Some people ask me what that means when I talk about a weighting or percent that I own. And just simply put, if you had a $100,000 portfolio and you were going to invest 5%, then you'd buy $5,000 worth of KRE, right? That would give you a 5% of your investable wealth in the regional banking sector. Did you notice there I mentioned investable wealth? Wow, what a great name for a company. In any case, so why do I like regional banks so much? Well, if you remember, I did like them a few years back. In fact, like 4 years ago, 2022, I made a similar move. That actually didn't work out because we went into the potential dreaded recession in 2023. There was all kind of panic about the inverted yield curve. And more importantly, in terms of regional banks, we had that mini banking crisis failure that literally only lasted like a weekend. But that really knocked out the regional banks in terms of being investable for many years. But I think all that's cleared up. And for a lot of the reasons I liked them then, I like them now. And this is also a reason that I'm not worried about the proposed 10% interest cap on credit cards. The little regional banks, they don't really issue a lot of credit card debt. They make their money on mortgages, small business loans, real estate, things like that. And by the way, we have not seen the commercial real estate, retail, and office space Armageddon that could have happened. And at this point, it doesn't look like it will. It looks like it's been diluted enough that we're going to get beyond that. But more importantly than that, it's net interest margin. That's where these regional banks really make their money. So that's the difference of the spread, right? They borrow money at a certain rate. They lend it out at a higher rate. Think about what you're getting in your local bank account. And I know you're saying, hey, John, I'm not dumb enough to keep my money in the local bank account. I have a money market fund, and I'm getting at least 4% interest. Yeah, that's because you're a smart, wealth-studying listener. But there is still and will always be a certain amount that stays in local checking and savings accounts. It's kind of that sticky money. You have to pay your electric bill every month, and you don't want to take the time to move it out of your money market fund or link that account. That's kind of a pain. And so you're going to keep a certain amount of money in your checking account or a local savings account. That sticky money, although may not be large on an individual basis, you multiply that by 150 million households across America, it's a big number. The banks are borrowing that money at maybe 0.5%, if that. You're probably lucky. I know there are tickler rates and promotional rates, but if you look at the average, I'm pretty sure last time I looked at the numbers, it was a good bit under 0.5%. Some of it really just being a fraction of a percent. So let's use 0.5% as a number. Let's assume the banks are borrowing that money, right, from their customers. So they're paying out 0.5% in interest. Well, they're turning around and loaning that on a 30-year mortgage at 6%, right? That's like 12 times multiple. And if they're loaning it out to a business for a 5-year business loan, or even better, if they're doing a home equity loan, then they're getting more than that. They're getting more than the 30-year mortgage rate in most cases. And by the way, there's a lot of money tied up in those super low interest rates below 3%, but at the same time, money burns a hole in people's pockets. And many, many people with low mortgage rates are going out and tapping into home equity loans, and they're paying, maybe as much as 8 or more %. So that's really good money and profitability for the regional banks. So when you heard all the people talk about the inverted yield curve that they were so worried about in 2022 and 2023, we have a 180-degree opposite of that now, and probably going forward, we're seeing a very severe and sharp steepening of the yield curve. Oh, and by the way, in terms of lending, the refinancing market has been dead for the last couple years, but as interest rates on 30-year mortgages are creeping down below 6%, you will see refinancing activity pick up, and that's another smaller pool of money for these regional banks. Okay, so beyond profitability, or actually totally related to profitability, these banks are not being rewarded and haven't been re-rated for the higher profitability that they're likely to have. And even if you just look at them on their current trading multiples, they're significantly lower than the regular markets. The S&P 500, because it's so concentrated with the Mag 7 and these big hyperscalers, you're paying a big value for that growth. And so if you look at a regional bank multiple, or its price per earnings ratio, it's probably trading at, 40, 45% discount to what you would pay for just investing in the S&P 500. And is the risk in small regional banks? Absolutely. But again, we're not buying them directly. My ownership is in KRE, and so my risk is spread out over more than 100 banks. So to me, I think that makes it potentially even more stable than investing directly in the S&P 500, especially if you're in a cap-weighted S&P 500 fund. Now, another reason I like regional banks, and this has to do with a confluence of 3 major long-term trends, and they're all, I believe, favorable to regional banks. Number 1 is artificial intelligence adaptation. AI is getting affordable enough where these small banks can invest in it to help them create agents to deal with not only internal transactions, but also customer service issues, and these have traditionally been very labor-intensive functions for banks. And so to the extent that they can adopt more artificial intelligence and automation, their productivity goes up, they make more in profits. And just to illustrate the point, I know this isn't a regional bank, but recently Wells Fargo took a hit to their earnings. And the reason for that, if you dug down in the numbers, was not because of operating losses from loan performance. It was that they had to pay so much out in severance packages. That means they're laying a lot of people off. If I remember correctly, just last quarter, they laid off something like, close to 6,000 employees. So yeah, they're paying a lot out now in severance packages. That's a headwind. But what does that mean for future profits and productivity? Well, it's likely to mean they're going to make a lot more money in the future because they've reduced their headcount significantly. So in the short term, let's say those severance packages end up costing, $500 million, $1 billion. That's a one-time hit. But going forward on an annualized basis, they're probably going to save, $2.5–3 billion every year. That's a double-digit growth to their profit earnings. Now, again, I know this is Wells Fargo, but we're seeing similar things, although on a smaller scale, carried out at these smaller regional banks. The other major long-term trend that's converging for these regional banks is deregulation. And this is on a number of fronts, and I'll just tick off a couple of them. But for one thing, we don't have as much of a threat of antitrust legislation as we had under the previous administration. So that means that, an industry that has had very little mergers and acquisitions over the last 18 years is really primed to have the big banks come in and buy these smaller regional banks. And even for the ones that don't get bought out, the smaller ones will likely merge to become larger regional banks. And when these banks get bought out, it's usually at a 20 or 30% premium. Again, all good news, I think, for an ETF like KRE. Another aspect of deregulation is oversight. There's different categories of risk, and the more assets that a bank holds, the more strict the regulators are on it. Well, there's a proposal to drastically raise that threshold, meaning that the smaller banks will just have less oversight, less compliance and issues to worry about. That'll give them less, red tape to fight through. And while there are questions of whether or not that gets put through or not, what is blatantly obvious is that whether the threshold gets raised or not, the regulators do seem like they're turning somewhat of a blind eye to these smaller banks. So again, it makes them more efficient. And then one other area of deregulation is the SLR. That's a supplementary leverage ratio. It basically means that a bank has to keep so much cash on hand to satisfy the regulatory requirements, and obviously the more money they have on hand, the less money they can lend out. Well, those numbers have been reduced by, I think in a lot of cases, 20%. So that gives the banks 20% more money they can not only lend out, but that they can also use for stock buybacks or to, you do those acquisitions we talked about. So all good news in terms of deregulation and how that can increase profitability. And then finally, that third major trend that's beneficial to regional banks is industrial policy. You hear me talking about that over and over again. I'm not going to stop because it is a huge impact to the overall economy. And every time there's reindustrialization or onshoring or a new factory built or refurbishing or expansion of an existing factory, a lot of that money, especially the foreign investment, goes to the big money center banks or to the JP Morgan Chases. But for every one of those big deals you hear announced in the news, there are literally hundreds or thousands of small business loans that are made by these regional banks to support that local small business biosphere that has to support the larger big factories. So to sum it all up, no, I'm not selling my bank stocks. I'm not only holding on to KRE, but I'm adding new money to it. And another reason for that I haven't even mentioned yet is the possibility of a nearly multi-decade technical breakout. Don't have time to talk about that in this episode. If I get a chance, maybe over the weekend or early next week, I'll put up a chart over at investablewealth.com, and maybe we'll do another episode on that. So watch for that blog post notification. And again, let me know if you're interested in a live stream YouTube Q&A session.